How do you think that this problem of loans getting bad from individual investors is going to affect the overall ecosystem? Do you see a systemic risk building up?
Can we identify what actually are good loans and bad loans? Bad loans are.
Why have we not been able to see a change in the way insurance products are sold or other financial products are slid down to the throats of individual investors?
Kanan, to be fair, these things happen all over the globe. The only way to solve this.
Are there any other financial products you think which are important to be regulated at this stage?
So I think that is the scale where you don't have much opportunity right now.
Today, we have Mr. Deepak Shenoy, the founder and CEO of Capitalmind with us. Capitalmind runs a PMS and manages over 2,000 crore rupees in assets for clients across India. Recently, Capitalmind received an in-principle approval from the SEBI to launch a mutual fund. In this episode, we'll try and understand about various sectoral and macroeconomic trends and their plans with the AMC. Hi Deepak, welcome to our show. Thank you so much for accepting our invite first of all, and really excited to have this conversation. Your investment philosophy focuses on disciplined process over prediction. How do you inculcate this philosophy in your investment research process, especially in a market that is, very revolved around noise, short-term predictions, etc.?
Firstly, thanks, Kanan. It's an honor to be on your platform. I think what is interesting from a prediction perspective is that it's impossible to live with something where your predictions go 1 or 0. You have to live with a range of predictions. That means things can happen the right way, they can happen in a more complex interplay of events, things can happen in the wrong order. A different outcome may happen. The company may have great results, but the stock price may fall. Therefore, it is impossible to actually predict the outcome of anything that you're doing. The bigger thing is to work with probabilities. So when you start researching, you're not thinking of, oh, this company will do well. You're thinking of the range of outcomes that it could have and the range of negative outcomes that it could have, which could therefore, then you have a risk of, say, I have a 30% risk here, I have a 40% risk there, I have a 10% risk here, and now what's the company doing to mitigate it? And at some point, just get in and say, okay, well, I think we have enough factors that drive us to believe that this company or this set of companies will do well in the future. Sometimes we don't know how to predict which is the winner in a sector. We like the sector, but we don't know how to predict the winners in a sector. So we buy a lot of companies in the sector, maybe 3 or 4. And then eventually narrow down on which one or 1 or 2 which we like. So when you start looking at things from I don't want to predict, but I want the range of possibilities, then your research actually goes up to another plane, because you're saying, listen, if I think that this company will, grow its order book by so much, I want to know for sure that the market itself has got the ability to absorb that order book, that the market itself is growing, because you can't be a growing company in a place where the order, the industry itself is stagnant. You want to therefore de-risk that this situation where you try to predict an order book of one company is predicated on your prediction or your ability to predict. Instead, you're actually going to make it more like, listen, there are so many factors, and if any of these factors work, the company tends to benefit. Therefore, the probabilities just add up. So it's a 50% probability of something and then a 70% probability of something else. You have to add up these probabilities or multiply them, if you look at it mathematically, in order to reach the conclusion that you do. And most times prediction markets are basically, or predicting markets is a difficult game, because you're wrong roughly half to 3/4 the time. You don't have to be right all the time. You can be wrong 50% of the time and still make a lot of money. So our idea is just that, make more money when you win, make less money, lose less money when you lose, and hope that you break even 50-50 on your predictions, and you will be fine. Therefore, you diversify, you create a lot more room in your portfolio for externalities. The externalities should be positive to you. So, you are looking for companies with positive non-linear triggers going into the future. You don't want boring companies that are very predictable, because boring companies that are very predictable don't grow. So you want companies with some kind of a trigger, something that is so radically unique about that company that if people start to recognize that, that company will go 4x or 5x, just by the fact that more recognition or more revenues may come its way. This is what I think it translates to when we say don't try to predict, try to respond instead. So you are saying, okay, every time that something happens, I'm going to use that information to base my next investment thesis on, or even to hone my current investment thesis, rather than say this is the only way to invest.
Got it. Since you spoke about a top-down analysis approach where you select the sectors first and then the companies within that. So how do you select sectors first of all, and then the companies? What all quant models or quantitative analysis methods do you use in selecting these sectors and companies?
So we don't necessarily choose sectors first. We actually choose sometimes sectors are a result of research, saying that okay, this area looks like it's going to do well, whether it's defense or railways or something like that. And then you might find companies in that. That's where more fundamental research goes in. But in a quantitative approach, you can either choose companies directly or sectors first and then companies. But the idea should be some kind of quantitative analysis goes behind it. So it could be an increasing profitability ratio, a profit to assets or a profit to turnover or profit to net worth. All of these are metrics. They are quantitative metrics. You can say, I'll arrange companies of this size by profit to net worth. Now, some will be 150%, some will be 20%, some will be 30%. So you want to take the top 20 companies and say, okay, I want to invest in those top 20 companies only. That would be a simple form of investing, where I say I only take one parameter. In another case, I might take 10 parameters and say profit to net worth, but also debt levels below this level, and also ROE is greater than this. So I have a valuation metric, I have a quality metric, I have a, so each of these metrics adds up to a quant number. And I say that the quant numbers, I'm going to rank stocks, and I'm going to choose only stocks which have a quant number above X. And that quant number is a combination of the valuation factor, the quality factor, maybe a momentum factor on prices, and something else. So once you have this combination, that's when you kind of select the top layer of stocks that kind of perform in it. It's not always necessary that you will get the best stocks. Sometimes you miss them because, let's say a company has been loss making for 10 years. Suddenly 1 year it starts turning out a massive profit. Your quantitative metric will not work, because it's like he's looking for 8 years or 10 years. It's like he's not going to find that. You have to be okay with missing some of the big winners. But as long as your quantitative strategy works in the long term, I think you should be fine.
Okay. What all tools do you use for when you say quantitative strategies?
Primarily data tools here. I think we're talking about, fundamentally, let's say you're looking at, you need profits, you need comparable numbers in terms of revenues, you need EBITDA margins, you need all the other P&L numbers, including the balance sheet, how much cash do you have, how much debt do you have, how much investments do you have, what's your trade receivables, what's your trade payables, how much are your inventories. Over time, if you have a time series of all of this, you can use this to determine quantitative metrics. Show me companies whose net working capital, which is receivables plus inventories minus payables, is equal to so much, or is less than so much, or less than certain percentage of revenues. So that way you know how leveraged this company is in terms of operating concept. Another case may be, what is the fixed asset turnover, turnover to fixed assets as a ratio. That tells you about how efficient your company is. In a third case, you might say, how much is my net profit yielding as a percentage of either net worth, which would then be ROE, or as a percentage of sales, which is primarily a profitability metric, or as a percentage of fixed assets, which is more asset turnover ratio, or not turnover ratio, but asset profitability ratio. So effectively, the way you design your metrics based on the underlying data, that is the data that you need as fodder for creating something like this. There's lots of tools. Screener has one, which allows you to download for every company. You can buy data from a bunch of other sources. You can go online and look for some free data from a bunch of places. All of these things are possible today. So therefore, they are tools that we use on a regular basis, bunch of them, whether it is screener, tijori, sometimes in case money control, some value research in case of funds, BSc and NSE for press releases. So all of these things are different sort of places where we look for data and tools, but we use this data to make our decisions, because that's the only way you can get the appropriate information about the company.
So when I was speaking of tools, I meant, do you use just Excel, or Python is also used, or other quantitative analysis?
Yeah, I mean, those are just analysis, because once you get the input data right, then you have to analyze it. How you analyze it, whether it's Excel or Python, it's a different thing. So we have our quantitative algorithms use Python.
Okay.
But they output data which gives you Excel, and that Excel data can be used and looked at in different ways.
Got it. Fine. So Capitalmind now has over 2,000 crores of assets under management. If I'm precise, then it's slightly over 2,200 crores, right? So how much of that consists of primary inflows made by the clients, and how much of it consists of the gains that have been booked and are accrued so far?
So we have been, of course, around for a long time. So we've grown our AUM carefully over the years. So we are roughly around 50 to 60% principal, and the rest have come from earnings. But a lot of customers have come, they've gone, they have taken their profits and shut, because they have either earned as much as they want to, or they needed the money to buy a house or something like that. So a lot of profits have already been booked. But yeah, I mean, we've made more or less half of the money is capital and half of the money is profits.
In one of your strategies, you say that you are using Mahatrends as a theme, which include financialization, logistics, energy transition, etc. What are the industry level tectonic shifts that you think are taking place to, for them to be labeled as Mahatrends?
Kanan, the problem with looking at trends is you can't predict when they will kind of happen, but they happen slowly. It's like saying, when did we shift to smartphones? I don't think there's an exact date, but after a certain point, everybody had smartphones, and then there was a process. So most of these Mahatrends are a process. They're not a trigger key. On this date, things will start moving. So it could be as simple as hospitality and tourism. For instance, where you say India is becoming more tourism friendly, people are traveling, people are living in hotels, they're buying premium hotels, they're buying premium transport, they're going on planes, they're going on first class train. There is more accessibility of many other tourism locations, whether it's religious, whether it is leisure, and even business travel to a very large extent is increasing. So what companies would you buy in that space? That would make a lot of sense. Surge India as a portfolio, which is in our PMS, has actually created a portfolio of about 35 companies encompassing these sectors. So financialization is simply the fact that more and more of our of the Indian population is buying financial assets rather than real. Real meaning gold and real estate. But if you go beyond gold and real estate, an FD is a financial product, equity is a financial product, mutual fund is a financial product, gold ETFs, not gold, but gold ETFs are a financial product which sit on top of gold itself, but that is purchased, and so on. So you got a fair bunch of financial products that are growing in India. So who benefits from this? The answer is, as we see in number of investors growing 30 or 40%, maybe it's the AMCs that grow, the companies that manage the money. Maybe it is the RTAs who register investors that invest in mutual funds. They benefit. Maybe the stock exchanges themselves benefit. Maybe the demat providers benefit. Maybe the people who provide loans or provide multi-layer wealth management solutions, they benefit. So all of these are players that benefit from a financialization concept. So financialization, one theme, domestic infrastructure, domestic consumption, two different things. Infrastructure is basically something that is invested by the government. Government is making more and more money every year. So if you're actually getting to a point where the government has enough money to spend on infrastructure, that infrastructure is going to be used by a number of consumers, and that could be airports, that could be ports, that could be roads, railways, bridges, anything of that sort. both the infrastructure players will succeed and also all the consumption that happens around them, whether it is by tourism and transport, whether it is by restaurants, by hotels, by more malls coming into these locations. I think these two areas are also very important. There's also the fact that India is moving more towards domestic manufacturing. Now, this is the biggest and most evident in defense. Some of it is already evident in the auto situation. India makes its own cars. It's one of maybe 6 or 7 countries that make their own cars. Most of the cars that other countries make, they made for their own consumption first and then they exported them. So whether it was Britain or Germany or Japan, that was the scene. America too. So these are the countries that make cars. Maybe Peugeot at France or France is another exception, and Korea. But we will be probably the 6th or 7th country that makes its own cars. So whether it's a Maruti, an M&M, a Tata, we have car brands in India. But we also don't have much in terms of defense. Defense is relatively outsourced to countries abroad, mostly because India is the largest arms importer in the world. We import almost everything. It's after 2022 that we shifted gears and said we should be manufacturing this stuff. Suddenly drones are manufactured in India, ships are manufactured in India, the military equipment is manufactured in India. Who benefits? A bunch of companies in the defense sector, bunch of companies in the industrial sector who serve the defense sector, downstream manufacturing, because to manufacture a ship, you need to buy equipment. That equipment needs to be made in India. So you're going to buy engines from an engineering company, you're going to buy pipes from a pipe company, you're going to buy wood, steel and aluminium from a bunch of companies. All of these companies stand to benefit, but at different degrees. So for an engine manufacturer of boats, this is a huge order. For a manufacturer of wood, this is probably one of the orders that they have. So it's like when you create a manufacturing setup, or domestic manufacturing setup, it will impact lot more than just the simple manufacturer that you are trying to target, but also downstream. Someone who makes machine tools, someone who makes logistics, all of the stuff that goes around the industrialization paradigm will benefit. I think that industrialization paradigm has not happened in India meaningfully. Now it's trying to happen. So take domestic manufacturing, and to a certain extent, this leads into energy independence / import substitution. We import a lot of crude. We want to replace it. How do we replace it? The answer is use more electric vehicles. That will therefore reduce the dependence on crude. Now, to use more electric vehicles, you need more electricity. So you need a whole electric supply chain. So in a way, that's infrastructure, but that's also going to help us do import substitution. And manufacturing also locally, like in defense, it's going to substitute imports. So import substitution is a large theme. Financialization is a large theme. So is domestic infrastructure. So is domestic consumption. I think these themes are key to the growth of the economy, and they will add a layer of, they will take the country from where it is to an area where this country can grow 4x or 5x, but it will be their specific niches that grow faster than the economy because they are under utilized or under invested in the current situation. Even logistics, cold chain logistics doesn't exist in India to a large extent. So to that extent, we are going to see cold chain logistics grow massively, but it will take 10 years for this to do so. So investing, you need to have a 5 to 10 year approach. So when we are looking at, telling people to buy Surge India, we actually say invest in this only if you have a 5-year horizon. Otherwise, it's difficult to justify long term, something in the short term for it, because something may work out, something may not. Our Surge India concept, where we are doing something like this, is primarily focused around building about 30 to 35 companies that do this. And the larger scale of themes is not very difficult to understand, because when I say Surge India, you know exactly what I mean. India will surge, India will do well, and I can give you 100 reasons why it should, but I am giving you specific areas in which India will surge. And I am saying let's concentrate only on those areas.
Okay, got it. So, if I have to talk about logistics, energy transition and import substitution, like you said, how do you see China as a competition to India? Like we are definitely talking about China +1 and how the world is diversifying. but the cost advantages and the manufacturing processes, and not just that, but technology advancement also that we get to see coming from China is second to none and by a far distance, right? So what are your views on, like I'm not talking about China as an economy and investing in China instead of India and Nifty 50. I'm speaking of China as a competition to these products which are our underlying.
So, to one extent, India doesn't like Chinese products to come in and ruin the experience here. For instance, we are not importing Chinese cars.
Okay.
Because we feel that they will be a threat to our cars.
Okay.
We don't allow China to invest easily in India, though almost 90% of all mobile phones in India are made in China. We don't have many made in India models so far, but when we do, we will probably be more aggressive towards China not coming in harder and undercutting us. To the extent that India is the market, I think China is a competitor to be wary of. But in the world stage, we are not anywhere close to China.
Okay.
We don't have the systems, we don't have the scale, we don't have the thought processes, we don't have the money. So let's leave this China plus 1, more like China plus 0.005. So if China gets 1, we get 0.005 of whatever, whether it is drug manufacturing APIs, whether it is industrial outputs, and electric vehicles, they are now huge compared to anything that we have done. So I think we should not look at China as a competitor. We should look at China as a partner in helping us grow. And in some cases, they will provide the raw materials for us to build the finished goods. That's where they're very useful.
Got it. First of all, congratulations that you recently got the SEBI's in principle approval for launching an AMC. But you're already running a very flourished and successful PMS business. And running an AMC in itself comes with crores of fixed cost in the first place without having even anything in AUMs and expense ratios, right, to bear with. So why do you want to foray into a large scale model than from servicing high net worth individual clients?
So we've been talking about this for a while. We actually charge like a mutual fund in the sense of we don't charge a performance fee. So we don't do a profit share. All your profits are yours, unlike most other PMSs. What we say there is, therefore, we are actually charging you like a mutual fund, then we should also get some of the advantages of a mutual fund. We can target people who have less than 50 lakhs. A lot of people want to try us out with 1 lakh or 2 lakhs. Today we can't even service them. Tomorrow we will be able to. We will be able to reach all parts of the country through RTAs who have their offices in every part of the country, whether it's Manipur on one side or Cochin on the other side or Jammu and Kashmir or Gandhinagar. I think if you have the right partners, that then you can build a really big high quality mutual fund business as well. There's also the question of a tax advantage, because mutual funds are not taxed on any transactions that you make in the mutual fund itself. It's the person that's taxed when they exit the fund. So that's a bigger advantage for them over PMSs. So that's a second layer of advantage. But the bigger layer of advantage for us is that we can do more things. We can do debt, we can do hybrids, which we can't do as a PMS.
But you can still do that as an AIF, right?
AIF hybrids are taxed much worse.
Okay.
So what happens is, if I buy a government bond and I get interest from it, I pay 40% tax, 39% tax as an AIF. But if I was a mutual fund, I pay 0 tax.
Right.
So then, instead of getting 1 rupee and paying 39 paisa to the government and have only 61 to reinvest, why not have the whole 100 to reinvest? That's the idea of the mutual fund.
So we'll have a Surge India Flexi Cap fund going forward?
Hopefully, we have a lot of plans. We haven't revealed exactly what the structure of the long-term mutual fund race is.
Got it. So SEBI recently curbed a few companies which were selling unlisted bonds on their platform. Do you think there should be a market for unlisted bonds as well? And rather than curbing those companies, the regulator should get it under their purview and in the ambit of the regulatory ecosystem rather than just curbing them?
So I think if you look at bonds, unlisted bonds, the problem is the regulator has seen a lot of phases when such bonds were not able to be sold. To give you an example, the ILFS case, the bonds went into some sort of liquidation. They're still being liquidated as we speak. The Z case, where you had a situation where a company had defaulted or defaulted to a certain extent, but the promoter promised to pay back. In cases such as Bhushan Steel, where of course there were no publicly traded bonds, but you had privately placed debt, and that debt saw 75% haircut. The regulator wants to reduce the occurrences of such situations. That's why they're actually saying no to this. But I think having a very good knowledge about the bond market is important for you to then therefore take these bets. And some of these bets are not available at retail sizes. So they may be available only at 5 crores plus. So you have to raise 100 crores of capital to be able to buy 20 such issues. So it's a difficult thing to do, to build in India. So I would say yes, it's an attractive proposition on the face of it, but should everyone do it? Given where you are right now and where stock markets tend to be versus bond markets, I would say you would probably do better in the stock market area in the long term. In the bond market area where your yields are very high, you got to be very careful, because people may be paying you very high yields because they are going to default. So you should be able to then use your discretion, your judgment to figure out which one to do. Most people don't have this ability to judge. Therefore, I say for the ordinary investor, it may not be the best option, but to sophisticated investors, PMSs, fund managers and so on, this always going to be the case. So for us as a PMS, we've chosen not to invest in these private bonds, mostly because we can't. SEBI doesn't allow us to invest in unlisted bonds of any sort. But why am I doing this as an individual? Because I think the same problem. Because if we actually see bond issues of certain size, the fear of default, and this has happened in many cases in the recent past as well, is going to drive away customers, especially who come to give us their money for a long term. So I would rather that they not be exposed to private bonds of that nature.
Got it. Are there any other financial products you think which are important to be regulated at this stage and are important for the larger ecosystem, not just company specific? Of course, if companies grow and there are instruments like these, like not everyone can not everyone can afford to get listed. It comes with crores of compliance cost
Correct.
every year, right?
Correct.
So for small businesses where fundraising is pretty difficult but necessary for the larger ecosystem to grow, what are some products which you think are not there in the regulatory ambit and are floating in the gray area, which should also come in the regulatory ambit so that even the investors are protected and the ecosystem as a whole also grows?
So I think angel investing is one, because you already have an enabling framework for that. You can go and become an angel investor in firms. If you have more than, I think, 2 crores of assets, you can become an accredited investor and you can go and invest directly into startups. I think that is the scale where you don't have much opportunity right now, but you want to build up to the point where there is opportunity and then show us the scale at which this can grow. And when you do that, maybe you can go public as well. So the number of people that have gone public are relatively small, but I think private capital has increased so much that there's a lot of private capital available to take people from 0 to 1 and 1 to 2. It's 2 plus that the stock market comes in. So I think it's a useful thing if you understand exactly what you're doing. I think of it as like this. Think of all investment money as charity.
Okay.
Into startups. Okay. So you think of it as, I have given the company this money, I will never get it back. If you think of it like that, then I think you'll end up living your life more peacefully and thinking that I gave this guy 5 lakhs and he's not returned anything. That guy has got 10 lakhs. He shut down his company. Oh, I invested in Dunzo and Dunzo is no longer existing. So yeah, these kind of things happen, and therefore if you think of it as charity, I gave away the money. It's never coming back. So any money that comes back to you is a bonus. So that I think is the way to think about it, but I think it belongs in certain sophisticated investor portfolios, but definitely not for everybody.
Okay. While that is for an individual's perspective, I'm talking about regulatory ambit. Like, while we already have AIFs who invest in, I'm talking about regulatory ambit. How can...
Yeah. So, for instance, they brought bond platforms into the regulatory ambit.
Right.
They have recently brought a bunch of other platforms as well. They were algorithmic trading platforms. They have been brought into the ambit, or there's a talk of bringing them into the ambit. There is a bunch of players that were doing selling of private, debt products, private equity products. So, the regulators come down on them and said, you can't do this, you need to be an exchange to do this. So, at some level, regulation is required across all this. The biggest thing I see that is a problem in the regulatory framework is P2P lending loans and frameworks that enable startups to actually just pitch, and even gold investment companies. They are not very well regulated. So, if a gold investment company tells you, I will give you 5 grams of gold and they pay you some units, there is no way, no easy way that you can take those units and translate them into gold. And you don't even know if there's gold underlying in the vaults.
Right.
So, you want to be sure of that. So, you want a little bit more regulation there. P2P lending, there has been a lot of regulatory changes in the last few months. So, I won't say there's been no regulation. So, I think that was unregulated relatively, now it is regulated. So, that is one, but most other spaces where there's finance involved are already regulated. IRDA covers the agents, covers the banks, RBI covers the banks by themselves, a bunch of things. Mutual funds control the brokers, SEBI controls the brokers, the mutual funds, the PMSs like us, and almost all other investing fund managers all together. So, I think that is where your regulations already in place. The influencer category sometimes does not get regulated as well. But now you are seeing that SEBI is going after people saying, listen, if you are not registered and you are giving people advice for a fee, then we will come in and we will do something. They have passed some orders. We don't know how long or how, if these orders will actually go down to SAT and get this thing and all that. But if it does happen where those orders are sustained, you might find that the regulatory setup has moved away from all these people to influencers also, or to some other kind of parties also. I would say the regulator will eventually come and catch up with you if you become someone of scale, no matter what you do.
That's true. Do you think that the crackdown on P2P lending companies was fair?
I think yes, to an extent that RBI actually didn't shut the whole business down. They said we wanted to continue.
In a sense,
no, but
they did.
The point
the way
is the companies were doing the wrong things.
Okay.
If I take a loan from you and you tell him you can come and buy Deepak's loan from me, even a part of it, saying you give me 100 rupees, chal theek hai, 50 rupees you give, and then I'll take the 50, and then it'll be like it'll pay me for some interest also, and then I'll give you the remaining. And then maybe you'll take for another 30 or another 60 from another person, parlay your entire loan off, and I'm sitting there saying, okay, I can't repay my loan. Now you took it, they've bought it, they've got the risk. The P2P platforms never even revealed to people that such things were happening, that the borrowers or the other lenders, co-lenders were taking over their portfolios, or that the borrowers, they didn't even know who the borrowers were many times, the lenders. That was always illegal right from the start.
And it's peer to peer.
Peer to peer. So,
that should
if I should know that I lent my money to you, but it was extremely painful to ask, because they would say, oh, we'll give it to you on demand. And then on demand means you'll get today's snapshot. But tomorrow the borrowers could have changed, because one borrower has borrowed more money, repaid one loan and taken a loan somewhere else. He's out of your pool of loans and he's into another pool of loans which you are not part of. But some other person has come in whose pool of loans. So you got a list of investors today, tomorrow it may not apply. So now they have shifted this to say, well, you can't do this, you can't do that, you can't do this. So once they have said that, you have to go back to traditional lending, even on a P2P basis. And traditional lending, nobody wanted to do. Every of these players wants to do like this gamified lending, if you may, which was called P2P. And to a certain extent, I think the regulations have come in and said, listen, a few will survive, we are okay with that. The rest of you who are not following the rules, need to kind of shut down or rethink their business plans.
Since you spoke of borrowers' habits, taking another loan, I think it's called loan stacking technically, that you take one loan to pay another, and that's how you fall into a debt trap. I'll come to that when I'll speak of this problem, increasing, the NPA menace at the individual borrower level. And then we'll also talk about, say, gaming platforms, how they are not good for the country, and F&O, whatever measures that the regulator has taken. But before that, since we were speaking of regulatory ambit, which all products should come under the regulatory ambit, it's very plain and clear and simple that some insurance sellers, not some, I'll say almost a lot of them, missell financial products, and even the way they are advertised. See, you are SEBI regulated and you have very, very stringent requirements of each and every word that you say, each and every claim that you make. SEBI registered investment advisors have to pay 3,000 to 7,000 every time they have to get an ad approved, and there are so many back and forths with the entity that approves that, the regulatory entity that approves that. But an insurance product is being marketed like anything. They can hire celebrities, but SEBI registered folks can't do that. That's one. Second, the people who are selling these financial products are also themselves not very qualified. While we are talking here for the products that are under the ambit of SEBI, like if we look at the RIA license requirements, they're so stringent that and a beginner can never begin with that. A PMS requires 5 crores worth of capital to begin with.
Yes.
So that's huge, right? So not just anyone can start it, but an insurance product is being sold at mass to the entire country, and we all know that there are better products always available, because if you're taking 60% commission, 70% commission on day one on the first year premium, that's going to sabotage the investor's returns on a long-term basis. So no matter what excuses anyone gives, it is bad, right? We all know that. So why have we not been able to see a change in the way insurance products are sold, or other financial products are, slid down to the throats of individual investors?
So, Kannan, to be fair, these things happen all over the globe. The only way to solve this is by education, because you can make a sucker out of anyone. By changing and twisting your words, guaranteeing returns. Now, insurance companies are allowed to guarantee returns because it's their balance sheet. They'll say, I'll give you 8% a year, I'll give you 6% a year, but they hide it. Instead of saying 6% a year, they say, oh, you give me 10 rupees every month, and then I'll give you 1,000 rupees for 2 months, and then 1,000 rupees or 500 rupees for 6 months. So, by the end of it, you need an Excel sheet and a fairly qualified PhD level Excel working analysis degree, which allows you to then say, oh, this IRR is so much, and I don't want a 6% IRR, I want a 10% IRR. And nobody is willing to give you 10%, because the whole reason why this whole rigmarole was invested was created was so that you would be fascinated by the words. Invest 1,000 rupees per month for 10 years, I'll give you back 2,000 rupees a month for 10 years. This is not complicated. This is this actually, it's about, in 10 years I'm doubling your money. So if from 10% in 10 years I'm doubling your money, your return is about 7%. This is not meaningfully large, but as I say this, even that isn't happening. You get 6%, 4% to 6% returns.
6% is also very high. As far as the products that I have analyzed so far, there are very few who give 6.5.
So now here's the interesting thing. The guy who will sell you this will say, sir, if I don't sell you this, then what will you do with your money? You will go and burn it, you will spend it. You will keep it in your savings bank account, and you will see some money and you will go and stupidly spend it, buy some car, something. At least I have it invested. I am giving you 4% more. Only 4%, I agree. But I have saved you from not doing, from doing stupid things. Which means that I will take credit for this behavioral aspect of it more than I will take credit for the investing aspect of it, right? Which is fine. I think that's how the market is, and people need protection from themselves.
Behavior, is that correct?
But it should not be missold as saying, listen, this is a 20% per year investment, but it actually is only 4%.
Right.
That is where the misselling comes. And I think the misselling has resulted in a lot of people getting cheesed off with real estate. Now, people like you have probably told the world 150 times, don't do this. The more people like you are saying this, the more people are saying, oh, well, you know what, maybe he's smart, so I need to reduce my focus, or at least ask the right questions. How do I ask the questions? I'd go to the insurance company and say, show me this. The minute you say that, by the way, the minute you say, 1 minute, I will open Excel and I'll put this data in, the guy on the other side bangs the phone down. Because he knows the minute you have an Excel sheet handy, you will never buy his product. They are looking at the guy who's driving or between some shopping for his this thing and all that. Sir, at 100,000 rupees for 10 months, 1,000 10 years, and then I'll give you back 2,000 for 10 years. Yeah, and after that, I'll give you, say, extra 50,000 rupees. Done. How much do you want? 1 lakh, 2 lakh? Take. So, he doesn't think of this as a bad thing. He just thinks of it as, I was anyway going to invest that money. This sounds like the right thing. India loves to say, kitna deti hai? The kitna deti hai has got to investment also. The first question you get is, when you're creating a new portfolio, how much will I get next year? I'm like, I don't know. Because in the past, it has gotten so much returns. I can't guarantee that the future will give you sort of return. The minute I say this, they'll say, sir, FD mein jaate, if I go to FD, I get, say, 8%. I am sure I'll get 8%. Why will I invest in you if you can't even give me 8%? But I'm saying, I'm not saying I can't give you 8%, but I can't tell you how much I'll give you. The last year we made 36% in our Surge India portfolio. The year before that also was fairly good. Now, right now, I have seen the Surge India portfolio outperform in the 1 year, 2 year, 3 year, 4 year, 5 year basis. Can I say the next 5 years will be an outperformance? And therefore, I will also make another 36%. I don't think so. And therefore, you have this mis-selling simply because people want a false illusion of certainty. I can come to you and sell you this policy and say it's 8%, sir. And if I sound convincing enough, you will believe it's 8%. So, I am abusing the trust you've given me because you think I am a financially intelligent person like a banker or an insurance broker or an insurance agent or a mutual fund distributor. You hope that these people they're coming to you because they're financially smart. You hope that they're telling you the truth. If they tell you lies, you have no way to cross-analyze it because you can't even open Excel. Most people are like that. They don't even know how to open Excel and use stuff. So, this mess selling happens at a level which thrives on uncertainty or the lack of education or lack of financial depth of the listener.
Right. And 99% of India would be that way, more than
which is why
99%,
people
right?
call up and ask for OTPs and people give them. And they complain that somebody has taken their money from their accounts. I'm like, please don't give OTPs. I mean, how difficult is that to understand? It's not some random person pretends to be an employee of the bank or an employee of a police company, police service, and you're going to give him crores of money. Like really, didn't you work hard to make those crores of money in the first place? Why would you just give it away to some person who's impersonating a phone officer on the phone? I think education is important. The more we tell people that don't do this, the more likely it is that they will get stymied.
And sir, what do you think, like, of course, is there any missing action from the regulator side? What can be done from the regulator side? Then I'll come on the education part of it.
The regulator keeps thinking they have to add more laws, but I think what's better is to say all these acts are an act of criminal fraud. Criminal fraud is available to be chased against by investigative agencies across India. You don't need a separate law for it. If you try to fraud me, I don't have to create a law that Kannan is not allowed to fraud Deepak Shenoy. I do not have to create such a law. Persons whose names start with K cannot fraud persons whose name starts with D. I mean, this is how India makes laws. That happened, so stop that thing. But like that, there are 100 other things. How many rules will you create? So now to tell a person that you have a service, an RA has to pay 3,000 rupees to this thing. But only if you are selling your service, not if you are not selling your service. So, but does a PMS have to pay anything for putting an ad out? Answer is no. Mutual fund? No. They don't have to pay any agency. So, why are they different and RAs are the same? Because there's been some abuses of these things by the research analyst community or the investment advisor community. So, I think we selectively create laws. That is what creates the problem of regulation being too much or too much of an overhang over running a business legitimately. But I think this is a dialogue between us and the regulator. At some point, the regulator will understand when it's too much. But by the law, you can go after people who are abusing it. and go after them to the extent that you can, you find the right thing. They've done it now. Recently, they've found people who are, I don't know, big people on Twitter and YouTube who are promising and guaranteeing returns. They've gone to them and said, pay back all that money. They can freeze bank accounts. Many times they've succeeded in getting the money as well. So that I think that part of the regulatory enforcement technique is a good thing. But I don't think they should introduce more laws against this. So creating more laws just muddies the picture. You already have enough laws to do it.
Got it. Now I'm largely speaking of insurance products here. While SEBI does not regulate that, the IRDAI does that, and 51% of health insurance premium in FY 23-24 was underwritten by bank insurance partners. So that's the extent of how bank influences the sales of financial products, especially insurance in the country. There is a regulatory overlap between RBI, SEBI and the IRDAI over here. That is where I'm asking, is there a miscommunication because of which the mis-selling which is happening through banks, especially of insurance products, is happening?
I think banks are fairly aware they're mis-selling products and everybody is aware. For instance, my mother who's 65 years old when this happened got a call from her banker saying you should buy this product. It's a retirement pension plan. Why does a person who's 65 years old who's not working need a pension plan? You either already got money, but you can't work towards a pension. It sounds like completely incongruent, but they were told to sell it because they have targets on each plan, right? So I think mis-selling is a problem because you've incentivized the system by saying two things. You sell, you get commission. You mis-sell, nothing bad happens to you. When did you see a banker who went to jail for mis-selling? Zero. It's never happened. Some poor fellow who's gone on YouTube and put something saying I guarantee returns, you will go against this thing, which is fair. But go after the bankers also. Go after the bank. Can you go after the big guys? The SBIs of India, where your banker is arbitrarily saying that if you don't take insurance from me, I will not give you a locker. Find the bankers, make sure they don't work in the banking system for 5 years. Can you do that? If you did that, mis-selling would stop. Go and find the CEO of the bank, 50% of his salary for every mis-selling incident. They did it in telecom. They said if I get a spam call, if somebody complains of a spam call, the CEO is fined 5,000 rupees or something like that. 5,000 per incident. But 100 spam calls, you're finished, no? I mean, some part of your salary is gone. So the CEOs were like, boss, find who is this spammer, shut him down. I don't want any spam calls. So the minute you introduce this harsher regulation, things will change. Now this regulation does not need to be introduced to hurt the small guys. You should go after the big guys. So the big guys are the ones where the mis-selling is the most. And the mis-selling is a very, it's like people call me and say, oh, sir, you have a bank account with us. Yes. We want to give you a service call. Okay. Your account is open. I know that. I am now using the account. But we also have a insurance plan to sell you. I said, why don't you start with that? Yeah? Because then I can tell you no from the beginning. You waste 5 minutes of my time saying there's something urgent to speak. You might as well tell me you have insurance. I will say no, bye-bye, and we're done. But no, they have to do this farce because they don't want to sell insurance. Oh, incidentally, we were talking to you and we sold insurance. So that's how it works. The problem then is, how do you ding them for mis-selling? Because they call for something else. And then they start talking about insurance, unless you recorded the call and you said, okay, they've told me this. And even then, IRDA does not take any cognizance, RBI does not take any cognizance, saying, oh, well, you didn't buy the product from him, so there's no mis-selling. I'm like, mis-selling is the act of mis-selling, not the act of having mis-sold something and then I realizing 1 year later that this is a crappy product, which is what happens to most people. So at some level, the barriers here, and you don't need new laws for this, like the CEO charge and all that stuff is not required. You just go after people with the current laws, and then you will find that it's enough laws to catch them.
Got it. Fair enough. Coming to financial habits of individual investors that are creating kind of a mess in the overall banking system, and we are facing not a crisis, I would say at this time, but definitely there is stress, and the RBI has also taken cognizance of that and changed some regulations, and called people to not do certain things and not just issue credit cards without diligence, and fine various banks as well. We, for over the last 2.5 years at One Finance, we have collected data of more than 5,000 individuals across 124 cities in India, where we have not just understood how they invest, how they spend, but we have also understood how they borrow and save for emergencies. Speaking of this particular problem, the Gen Zs, we have over close to 800 to 900 people of cohort in the Gen Z category, which we of whom we have collected the data. 12% of their assets is allocated towards bad loans. An acceptable range should be 0 to 2 to 3%. Bad loans are typically anything other than a home loan, a property loan, a business loan, or an education loan, which is basically for an appreciating asset, be it skill set, be it business, or be it a property, right? Auto loans, personal loans, and all other kind of consumer loans are bad loans in this definition. It's far higher from Gen X, far higher from millennials. While millennials are also not very savvy with this particular thing, but Gen Zs are at a different tangent. How do you think that this problem, which is being imported with the westernization culture, our savings rate has also dipped to I think a very long time low, I would say. How do you think that this problem of loans getting bad from individual investors is going to affect the overall ecosystem? Do you see a systemic risk building up?
So you would have to look at this from a perspective of, when you say bad loans, you just say as loans that don't have an asset against or don't have an appreciating asset. I don't think that's fair, because a person that uses a car, takes a car loan, sometimes he uses it to get to his job and back and be able to do his job better, which helps his income prospects. And therefore, the income prospects gives him more play. He's able to take his family out for a weekend without having to wait for autos or buses, and therefore he's able to do things in a better way. I don't think such things which are help to improve the quality of life, and if you take a certain amount of leverage to do things, I don't think it's a bad idea.
Okay.
Houses, in fact, are worse, because you tend to take a house which is 5 times or 6 times your income.
Right.
Your usual borrowing of a loan is like 10% or 20% of your income, maybe 40% of your income at any point in time. But the housing loan is like 10x your income, and half the loan you don't even get the property. You have given it to builder. The builder is shown you some plot, and you have to pay EMI for it. How is that safer than a car loan where I can at least repossess the car?
Right.
The loan in which the house has been given, he's probably built some cement in the bottom and that's it, and he's taken 40 lakhs from you. Now, how will I recover 40 lakhs from something that has cement and concrete?
But then there are sufficient laws now in the name of RERA and all, and then the banks do not just sanction any project right now. I am not talking about the fiasco that happened in the times of super tech, supernovas of the world.
Well, 5 days ago, Ozone, both the promoters of Ozone are in jail for having frauded. They're a Bangalore company. They frauded people of 3,300 crores. How? Under construction projects, take money and then move to another project and take money for that project. And
Despite
all of these things, maybe people have put their own capital, but a lot of it has come from bank loans as well. Now, who pays back the bank loans? Even if these people are frauds, it's the individuals who are responsible for paying back the bank loans.
Right.
Right. So now you've created a problem where there was supposed to be no problem. You said home loans are good, but home loans are bad. Whereas the same guys who are taking loans to fund their children's marriages, or to buy cars, or to maybe a personal loan to, I don't know, travel abroad for a course, which will not be classified as education, because education is only formal education. So if I go abroad and learn a cooking course, that will not be coming as an education loan. But if I learn that cooking course and come back and start a business in India, it gives me enough income to grow. So I think this bad versus good are incorrect classifications. What is better to classify is, are people able to meet 3 things? Do you have collateral? Do you have credit worthiness? And do you have the capacity to repay? If you don't meet any of the three criteria, obviously things are bad, and that you are giving unsecured loans without any idea of anything that's happening. That random fellow on the road has given you his PAN number and he has shown you some 5 transactions in his bank account, and you think it's income because you have some AI algorithm that thought it's income, and you've given him the loan. He's never going to pay it back, and you should be aware of that. Of course, that is dumb lending. But if somebody comes where you have a history in terms of a salary and things are coming on a regular basis, this person is married, has children, has stability, wants to therefore upgrade his lifestyle by maybe buying a new TV, does that make him a bad loan? Most likely that money is actually coming back. So Bajaj Finance has shown you that. Over 20 years they have lent to people who are buying TVs, which is the most depreciable asset possible, and yet they have got all their money back. Or most of their money back. They haven't had this. The problem of bad lending comes when you aren't able to do proper risk assessment of customers, by not taking enough data, by not doing enough grounding work, of not doing enough understanding of the underlying market per se. That is when I think you have a problem. So whether it is whether you will be a Bajaj or you will be an ILFS, which is an industrial lender which did not do very well, or if you will be a DHFL, where there was actual fraud in the operations itself, but the company was very sound in terms of being able to lend and all that, but there was some fraud at the promoter level, at some kind of management level. That determines pretty much whether you are a good lender or not. So I think RBI has done an interesting thing of curbing some of these lending activities, where there is absolutely no collateral, but because they don't have any idea of what constitutes collateral and what doesn't. I mean, they do have an idea, but they choose to say that anything that is uncollateralized personal loans should be considered bad. So they have used a hammer to kill a mosquito, and the hammer is going to cause more damage. So at some level, yes, we have a problem, but I think using a larger hammer to break down the entire thing, rather than say let's try to increase the visibility of these loans across the system. It's happening now. Now they are saying that if you take a loan and somebody else takes a loan, I mean you take a loan from me and then you take a loan from somebody else. Earlier it used to take 1 month for that other person to know that you have taken a loan from me already.
Got it.
Today it will take only 15 days. Tomorrow they want to make it real time. As soon as I take the loan, that everybody in the system will get to know that Deepak has taken a loan from somebody. And then they will know that Deepak has already got so many loans pending. So why is he taking another loan? You can make these decisions upfront. And so also there is data sharing among microfinance borrowers. They use PAN numbers to say, okay, this person has borrowed from 3 microfinance companies. I will not be the 4th. So this kind of data sharing is happening, and it will curb any excessive lending, excessive borrowing on a per person basis. But having said that, I think lending money is one of the oldest professions in the world, and borrowing money is therefore one of the older professions in the world. So therefore, people who borrow money have gone through an evolutionary cycle where they know ends of a lot of things. The write-offs that a lot of these startups have are related to the lending techniques that they used, and they want to hide it from their NPAs, because otherwise I would show you a 10% NPA, you will get cited.
Right.
Now, so what I do is I write off 8% and I show 2% NPAs. So because I have capital, I have the ability to raise capital. I say, okay, I use my capital, I write it off. So when I write it off, you are thinking my books are okay, but I am thinking I have written it off naam ke vaste. I will still try and go and get these people to pay. One or two people will pay. That will sound like an extra bonus, because you've written off the loan, now it sounds like a profit. You've written off the loan in 2024, the money has come back in 2026, my 2026 accounts looks really good. Right? So at some level, lending is a complex exercise, and it requires so much work for an investor to even understand how the books have been progressed, that you're right in that it's complicated. But I think classifying people as bad, loans was bad versus good, just on the basis of
the category of
category is not right. I think you should go down this a little more and say, can we identify what actually are good loans and bad loans? Bad loans are behavioral. I mean, once in a while, see, you lose your job, तुम्हारा default हो गया, not a problem. My problem is if you have defaulted with 7 other people, why should I give you a loan?
Absolutely.
Why did I not check those 7 people earlier, right? And that is where I think a lot of lenders have halted, because it takes time to check and they want instant loans. I want to buy a TV right now. You don't give me a loan, I'll go to somebody else.
Competing with P2P platforms.
Yeah. So at some level you're that, So what do you do?
Got it. Speaking of the behavioral aspect only, like let's not go into good and bad, the definition of good and bad, but definitely we are seeing increasing stress in the number of personal loans that have been issued in the last few years, and the credit cards, etc. So do you think that is a systemic risk? Again, like not going into the definition of good and bad?
It's not big enough to be systemic.
At this point. Risk. Okay.
It's small. It's about maybe 12 to 14 lakh crores, the total size of maybe 20 lakh crores. I think maybe less than 20 lakh crores, the size of the total unsecured loan market. Of that unsecured loan, a significant number of loans will be taken to run businesses, to improve houses. So for instance, I have bought the house, but I don't have money for interiors. Instead of topping up my home loan, I take a personal loan. My sister wants a loan, my niece wants a loan to start her business. I take a loan, give them the money. It's unsecured to you, but I know that the business will do well. So all these are relatively good loans. The bad eggs, there will be a lot of bad eggs. That will be cause maybe a 1 lakh crore hole or 2 lakh crore hole. Now in a 200 lakh crore asset book that's there in the banks right now, 1 lakh crore or 2 lakh crore is just 0.5% or 1%. I don't think that's meaningfully large. So it's not systemic, but it's a real risk. It's a real risk because it could balloon. Right. These people can keep evergreening their loans and borrowing and over borrowing, and at some point everybody will be stuck.
And that may be through informal sources of lending as well.
They might have already taken, they might be going to the banks to repay the he'll break my hands and legs, so might as well take a loan from a bank. Then I pretend I will do PDF editing, put salary slip, all that, because who wants their hands broken? So at some level, people do all sorts of strange things.
Because an informal lending gets captured. Informal lending behavior doesn't get captured in the CIBIL, so the formal sector will never get to know that.
Exactly. You lend your money to your friend,
and he's never going to pay back.
If you keep forcing him, he will go and borrow money from NBFC,
right,
and pay you. But the NBFC doesn't know that you've given him the money.
Got it. What is your personal asset mix as of date?
Today, I'm still about 80% plus in equities. I need some money now because my son's in 12th standard, so I have moved some money to an arbitrage fund so that I can fund at least a year or two of his education. The rest of the money is sitting in equities.
And where do you invest? 20% is in, say, arbitrage or debt, and the rest is in 100% in equities.
In equities. So it's in my PMS.
Okay, Surge India and other strategies.
And momentum and so on.
You have no allocation whatsoever to gold?
You won't believe it. Yesterday we talked about selling all our gold.
Why?
Because it's a pain to keep it in the house. So we're like, okay, let's sell it and use the money to do something else. But this idea didn't come from me. My wife told me this.
Okay.
So we're going to have to find, it's also a pain to find somebody who will take gold and give money instead of saying that I'll take gold and give you some other jewelry. I don't want other jewelry. I'm like, dude, we're done. So let's say that is the case. I don't feel like I need gold in my portfolio at all. I might buy gold for a short-term punt, but I don't really believe in gold.
But like we did a research of 25 emerging market countries across 25-year time frames, of course, to the extent data was available of other countries, and analyzed that only India has beaten, amongst all of these other countries, only India has beaten, India's Nifty 50 index has beaten local currency gold returns. But not on a risk to reward ratio basis, right? So why do we say that we should not have any allocation whatsoever to?
I think everybody can have their own allocation. I don't have allocation. I don't believe in gold. So
that's what I'm asking. Like I'm assuming that what you're saying is what you're advising. So that's what I'm asking.
So interestingly, we don't advise people. So as in, I don't tell people this is what you should do. So if you give me money, I won't invest in gold. You want to invest in gold, it's yours. It's like the same reason why I don't invest in real estate. I'm sure hundreds of people have made money in real estate. Gold has not beaten equity returns in India on a 5-year or a 10-year time frame in the last 15 years on any rolling 10-year or maybe for 2 years in a stretch it has. 2000, 14 to 2016. So we do a chart of Nifty returns with inflation.
So even on a 25-year period, it hasn't, but on a risk to reward basis, it has. Like
No. So when you say risk to reward,
yeah,
it is basically taking the volatility as the
standard
underside.
deviation. Yeah.
You know what has beaten everything on that chart? Fixed deposits. You cannot beat the risk reward of fixed deposit because you are saying volatility is say 1%, right? And return is 10%. So it's 10% divided by 1. Whereas in stock market return is 15%, but volatility is 2%. So 15% divided by 2 is 7.5. So 7.5 is less than 10. Therefore, but my fund FD has zero volatility. Is maybe some volatility, maybe 0.0001%. So my 8% divided by 0.001 is looks like a huge number. You don't adjust for volatility by dividing it. What you do is this: there are volatility thresholds. I have a volatility threshold of 30%. I am a high risk investor. When I am willing to take 30% volatility, give me the highest return I can get for that 30% volatility. Gold is less, that's fine. Equities is less than 30% for the most part, that's fine. So I will take the maximum risk I can for maximum reward I can for 30%, up to 30% risk. You may be a 10% risk investor. For you, gold may qualify because its volatility is only say, but gold has fallen 40%. So I shouldn't say that, this thing. So gold does have a 15-20% volatility inbuilt in it. So assuming that you have a 20% volatility range, I might say, okay, you are not fit for equity, but you are okay with gold. So you could buy some gold and keep it because you are a 20% volatility range, or you could say, I'll put 10% of my assets in gold, 10% in equity, 80% in fixed deposits. Then I build a profile that is more suited to my risk taking ability, right? So my funda is, when you adjust for volatility, it is just this: there is a high risk investor who has a 30% volatility threshold, there is a medium risk investor who has a 12% volatility threshold, and there is a low risk investor who has a 0% volatility threshold. The 0% investor wants only a fixed deposit, and you should never tell him anything else. Maybe an arbitrage fund if he is willing to take a little bit of intra-month risk. But once you cross the threshold of say 12%, then maybe parts of gold come into play for which gold will make returns. But absolute returns over a long period of time, average over many periods, the gold has beaten equities very, very few times in any 10-year window, going from when I have data, which is I think 2004 onwards.
I'm not talking about just India, I'm talking about other emerging market economies as well.
Yeah, I mean Korea for instance has suffered a lot.
Korea, China, Malaysia.
China is a terrible market for investments
Right.
in any case. They haven't made any money despite their economy growing like 100 times or 20 times or something like that.
So you are saying that there's like, of course, there is possibility, but there's very less likelihood that we'll end up being like these countries in the next 25 years, and hence gold should still not be a part of your portfolio. As
Yeah, I mean, I don't think it's a great. I would rather choose equities because I'll make more money on equities than I will on gold.
Okay.
So if you give me an asset that is as volatile as gold, I don't care about it. The only asset I care about is debt or arbitrage, which gives me low volatility fixed income kind of returns. So that I can take. But you give me a high volatile product like equity and zero volatile product like debt, I can make a combination and come to any volatility profile, 20-10, 80-20. I don't need gold. Gold is a third layer diversification, same as Bitcoin. It is artificially paying for something that other people think have value, but it inherently has no value. You can't use gold meaningfully, right? So only thing you can do is wear ornaments out of it, though it looks good. So there is that, of course, so
that has traditionally been the trend, and then gold has some industrial use cases as well. And
very, very slight, less than silver. So in fact, silver is better that way. You should have silver.
But then people are wearing it like on their marriages, and this trend is not seeming to stop, right?
Yeah, but have you tried selling a gold ornament for gold itself, for money? It's a pain.
Let's talk about gold ETFs then, or SGBs then.
Gold ETFs you can't wear. So it loses
no, I'm
the
not
wearable.
talking about that. I'm talking about gold as an investment.
Yes. So now gold as an investment is the same as Bitcoin as an investment to me. It's got great speculative value, but very little real value in the financial world.
Okay.
In the real world, you can actually use gold to wear stuff, then it's great. It's like a house. It's not an investment, it's a expenditure. You wear it, you feel good. It has some value if you are desperate to sell it. You just don't know what that value is. And you can feel good that you feel rich, that you own something that is of value.
Fine. Say in times of crisis, like whenever we have seen any kind of war happening or anything, like I get your point that you're saying it has got no real value as such, it has got more of speculative value. But traditionally, over centuries, it has been seen that whenever there's a global crisis, which impacts economies at large, like we saw Russia-Ukraine, like we saw the Israel-Hamas war, whenever there's a conflict arising, gold comes to the rescue. If I talk about equity and debt, both of the markets will be shut. If there are bad times or their liquidation value, if at all anything, would be very less. Then should we not have 5-10% of our portfolios allocated to gold?
Then why don't you have it to guns? Because in a real crisis, only guns will make more sense.
Right.
Because that's the real crisis, right? You can take your gun and threaten someone else who has gold and take his gold, and you'll have a gun and gold. So the problem with that argument is that this extreme crisis situation, will hurt everybody at large, and in a Hamas or Israel-Gaza kind of situation where there are innocent Palestinians who are getting bombed for no reason, what we use is your gold or your guns. It is a completely lost case. You can't do anything, and you try to escape using gold, they will take your gold and you will still die. So it is an extreme case. So the more extreme you make it, the more difficult it is to justify any form of investment.
Got it.
So at some level, you want some normalcy in the world. So I don't think you want to invest for that kind of a case. I said it's a great short-term investment. So when you say there's a crisis, then you can invest during that crisis until that crisis goes away, and then it will come back down. Now I'll give you an example. Gold is now at $2,600 a troy ounce. It was $2,000 a troy ounce in 2011. So it's 14 years to get 30% returns. 2,600?
In rupee terms, we get more, but
rupee terms we actually got more, not just because of that, but because India increased the duties. Now the duty is 6%. It used to be 14%.
14%.
So it was got cut lately. But assume that the rupee depreciation was 4%, and this was this. So we got 10% more instead of 30% overall, which is 2% a year over 14 years. India got 12% a year. Right, because 10% a year came from rupee depreciation plus the duty, and another. And by the way, the duty was one time, but assume that 6% is applicable across. So either ways, you got certain amount of return, but that return is still less than the equity return for that same time frame. And I'm still talking top to top. So 2,000 to 2,600 today. Now tomorrow, if it fell to say 1,700. And the rupee appreciated a little bit from 86 to 82 or something like that, you would find that your losses in rupee terms would be quite high. But nobody will say that this is a problem, because they'll say, oh, it's only for a rainy day, it's so in case there's a crisis. Right? It's not like stocks where you're saying, oh, stock gir gaya 30%, isko becho. Because people have this unnatural affinity for gold. But as inflation comes on, gold is usually a hedge for inflation. Okay, so because the value of gold keeps going up, at least to the extent of inflation. What will happen is, if inflation is coming down, the value and the desire for gold will come down over a period of time. Now, to a short-term investor, it might sound like this, but a lot of India has created a lot of demand for gold by simply reducing the effort required, reducing the avenues available to purchase or sell gold. You can't sell gold easily, so you don't. People don't like to, you go to a jewelry shop, and I'm going to have this exercise over the next few weeks, is to go to a jewelry shop and try to actually get money for gold that I have bought like 10 or 20 years ago, which I mean not even bought, it was gifted to us during the marriages and so on. It's difficult, and therefore people don't sell it. If it was as easy as selling it on a exchange, I would do it in 5 minutes. I think gold is an interesting addition to people's portfolios. And by the way, even in my company, other people will disagree with me. And I'm okay with that. I may not be the greatest person to run gold, but tomorrow when we run a mutual fund, we may have a gold ETF because people want to invest. It doesn't mean that I have to recommend to them that they should invest. If there is an investing interest and we can do it, why not?
Got it.
It doesn't mean that we will, and even then we will tell you that this is the return of gold over 20 years. You want to invest, you want to save for your kid's wedding, do it. It's a better way actually. Instead of buying gold every year, buy a gold ETF or buy a gold mutual fund over a period of time. And eventually, when the time comes for you to buy the gold, sell the gold mutual fund, use the money to buy the gold, actual gold, and then take it forward. It's a very good thought process. Because you want to buy it for future consumption. It's like, I know I need a TV in 20 years, let me start saving for it.
Goal-based planning.
Goal-based planning. Because I would rather you do that than to wait for that time and then try to take a loan to buy the gold.
Got it.
So it's better to plan for it that way. So I don't mind creating a gold mutual fund. But if you ask me whether in my portfolio should I have gold, I don't care for it. Okay. I think I will not have a need for it right now, and if I do have a need, I'll liquidate some other investment and buy it.
Right.
And if you ask me today, what does gold give me in terms of downside protection, I would say it gives me something. But if I want downside protection, I'll buy debt.
Okay.
So I'll buy. So for instance, I could have a fixed deposit as SBI, because if SBI goes down, then we are in a crisis which requires guns, not gold.
Got it. Since you spoke of rupee nosediving against the dollar, why is that happening, and what should the government do to stop it, if at all?
They don't need to do anything to stop it meaningfully. But what I think is that if you decide to stop it from rising, because they do that all the time, you should stop it from falling also. So protect us on both directions, or don't protect us at all. If you don't protect us at all, yes, it will go down to 85, 90, but it will come back to 70. Then it will go back to 80, then it will come back to 70. It will be more volatile. You should be able to live with that. I'm happy to live with volatility. Nobody tells you to control onion prices. It goes from 10 rupees to 60 rupees and comes back to 10 rupees. We have learned to live with it. एक महीना onion नहीं चलाएंगे, चलो ठीक है, onion नहीं खरीदेंगे if it's too expensive. But so what? Next month, today is January 2025. You're getting Instamart begging you to take onion from them at 7 rupees for half a kg. And this is Instamart. It's obviously more expensive than the wholesale markets. At the wholesale markets, I'm sure you're getting 5 rupees a kg. The same onion that was 60 rupees a kg in November of last year, which is 2 months ago, is now available. We're okay with this volatility. Why are we not okay with volatility in the rupee? The rupee can go from 70, become 85, come back to 70. We should do that. But to keep it in a narrow band, the RBI said, listen, we won't let it appreciate. Because more money was coming in. When money was coming in, RBI said, oh, if more money comes in, the rupee will go to 75. We can't have that. Let's buy. So they bought dollars so that the market would not see those dollars. So the market, when the dollars come into the market, the demand is of rupees, not of dollars. They are giving dollars, they are selling dollars, buying rupees. That's what investors abroad are doing. So you bought those dollars. Now when they are taking the money out, they are giving back the rupees and saying, give me dollars. And the RBI is saying, wait, I am not giving you my dollars. I am not giving you enough. You give me 100 rupees, instead of giving you 1.3 dollars, I will give you 1.2. So the rupee exchange rate falls because of this. The mechanism is slightly different, but the rupee exchange rate falls because RBI is not participating enough. So either the government has to do more, government meaning the RBI has to do more, or it has to do nothing at all in both directions. Let the rupee go to 70 if it has to, that's fine. So if it were to do that, then I'd be happy. I think what's happening right now is that foreign investors have come in the last year or so, but now they're taking the money out. It's natural. Once in a while, they take their money out. Maybe it's because of Trump, maybe it's because India's results are not so good, whatever it is. When they take the money out, they will demand dollars, and the only person in the country who has a lot of dollars is the RBI. If the RBI doesn't give enough dollars, the rupee exchange rate will fall. That's what's happening. And I think it should be a short-term phenomenon, and I think it should unwind itself, because eventually foreign investors bring their money back in.
So thank you so much for your time, Deepak. I would like to just conclude with one question from you. Since our audience largely consists of financial advisors, the registered investment advisors and qualified financial advisors, uh, what is your take on how they should be advising their clients? Is there a change required at a larger level that you think they should incorporate while advising clients, especially with the changing, income expense dynamics that we are seeing in the coming generations?
So my feeling here is I'm not an advisor, so I'm not the right person to. So of course, a lot of people look at us and say, "Can you help us organize our lives?" And I generally give them some very basic frameworks to do. So I wrote a book on this. Uh, there are hygiene elements which involve your emergency fund, which involve health and life insurance. There are core elements which involve your retirement and your kids' education and things like that. Purchases like a house at some point, a car at some point, and so on. Once you go past that, it's the expenses that you should be spending. One of the things I don't find advisors doing very often is telling people to spend their money. Because somehow advisors feel ki yaar, you save this much more money, you can retire 3 years earlier. The guy doesn't want to retire 3 years earlier. क्या करेगा वो 52 पर रिटायर होके? नहीं, बोला ज़बरदस्ती रिटायर करवा रहा हो for saving money that he could spend right now. He's okay waiting till 55 to spend his money, and there are lots of positive externalities that can happen, bonuses, certain other things can happen in your life, inheritance. All of this stuff can be an additional bonus whenever you come. Why do you want to starve a person's life? And this is not a problem across all advisors. Many advisors understand this. Many clients push back, saying, "Boss, ye kharcha to hai. I have this. You tell me beyond this stuff, right? I have to have a holiday once in a year. That is a good, nice 10-day holiday. I want to visit my parents. I want to visit my uncle, my sister, my whatever, once a year or once in 2 years or something like that." So you figure out a way around everything else because I have only this much money available to spend, to invest, and then you can at some point if the money is too less, you can say, "Hey, boss, you can't reach your goals with this. Please spend less." But I have noticed that even for people who have more than enough money, they are saying, no, take that money also, invest it here. Take this money. I tell people, "Boss, this is done, yeah, go and spend this money." So, once you're done with your goals, the idea that it should be that you should spend. Second one is you shouldn't be overly conservative or overly excited about returns. So anybody who takes more than 12% returns is suspect. Why? Why are you taking more than 12% returns? Because the markets in the long term are giving you 12%. You can get lucky, but so what? You can't bet on getting lucky, right? So you can't bet on that. So you should actually say, I'll model my future growth at 12% equity, 7% debt maybe, and then see where it goes from there. The minute you do that, you will find out that whether this person needs more SIP, less SIP, whatever. The last bit is don't start evaluating everything on a 1 year time scale. No advisor worth his salt is doing this. But I think this 1 year time frame is where investors come to you and say, "1 saal ho gaya, no return." That is the time when you need to be ready with an answer that tells people, listen, it's not about 1 year. It's about 3 years, 5 years minimum. Because if you don't think in those time frames, equity is not for you. And if you are able to have that very clear mindset, people will agree with you and believe you. I've had a lot of conversations like this. I've said, listen, I can do 2 things. I can give you back your money right now, saying 1 year return is less than the index, or you stay with me for 3 years and then you tell me that this is not possible, or this is not this thing, it's not working out, and then I will completely agree. But right now I don't agree. 1 year is too less a time frame. There are multiple reasons. Business cycles take longer time. Businesses take time to evolve. Momentum as a strategy or Surge India as a strategy is not going to. I am thinking of an India over 10 years. You are telling me to perform in 1 year. I am not going to be able to do that. So, if you want 1 year performance, go to an FD, go to an arbitrage fund, they will give you. But will you be able to get that performance in a fund like ours? No. The minute I say that, people get convinced or people are mostly are like, okay, theek hai, we understand. But there are people who don't, and that's fine. I have no grudge against them. I think this thing. But remember that you have to figure out where you stand. Because if you are going to be like, they're going to come to you and say, 1 year you have advised me 5 funds, 4 funds are doing well, 1 fund is doing badly, let's get out of that. The very easy answer to say is yes. I think it takes a little bit of effort to say no, we'll stick with the 5. Because what is bad today will be good tomorrow. What is good today will be bad tomorrow. It's okay, net we will make some good money. And that net is what you should focus on, not the fact that 1 fund is doing. Now, if the fund is underperformed for 3-4 years consecutively, I can think, yes, we should do this. If you have good reason to believe that, let's say, an interest rate cycle is over, you're invested in a debt fund, you don't want to be in that, that's fine. But the minute you're making performance calls on a 1 year basis, you have a problem. So I think these 3 things, tell people to spend, don't overestimate returns or underestimate returns, make it too conservative, and then also to tell people about this part. So I think if these elements are followed in general, these are the common advisor problems that I think we all advisors and fund managers face. Everybody wants 1 year returns. Everybody wants either too high expectation or too low. Too low though we never face, but too high we face as an expectation. And third one is people don't know what to do with their money. They have too much of it. They don't want to spend it. I know this is an odd problem to have, but advisors are usually employed by people who have too much money. नहीं तो किसी के पास पैसा नहीं होता है advice लेने का. So when you have too much money and you're paying for an advisor, that is when you know that you should encourage the person to also spend his money. It will help you only because he'll buy things that your own companies will be creating. So might as well this thing it. And money's only objective is to be spent. You leaving it for your children is a waste of time.
Got it. So thank you so much for your time. It was really an insightful conversation.
Thanks,
Thank you.
Kanan.